Debt investments are different from equity investments in that you do not own a piece of the company. Instead, you are lending funds to the company to be paid back to you at a later date. Suppose you lend $100 to Company X through its crowdfunded debt, due in 3 years at 10% interest. The initial amount you lend, $100, is known as the principal. In return for borrowing your $100, the company promises to pay you 10% or $10 per year for each year you are lending money to the business. After 3 years, the business has an obligation to repay your principal investment, $100. Assuming the business survives those 3 years and is able to repay its debt in full, you will collect $130 at the end of the 3 years for your $100 investment today. Thus, debt investments have limited upside. You can earn no more than your original investment plus interest. However, just like equity investments, debt investments are also inherently risky. If the business goes bankrupt, you can lose your entire principal. In certain cases, the company has an obligation to pay back debt investments according to the contract terms. Thus, debt investments are more predictable in when and how much you will be paid for your investment. This concludes our introduction to debt crowdfunding investments. For more instructional videos on the ABCs of crowdfunding, visit www.crowdprof.com.